Imagine a time when you could invest your hard-earned money into a company, only to find out later that the company's financial reports were a complete fabrication, or that insiders were secretly manipulating its stock price for their own gain. This was the Wild West of American finance. The catastrophic Wall Street crash of 1929 and the subsequent Great Depression directly exposed these rampant abuses and a severe lack of investor protection, leading to the creation of the Securities and Exchange Commission, or SEC, to bring order and trust to the markets. Before the 1920s, there was very little federal oversight of the stock market. Instead, regulation largely fell to individual states, often through what were called blue sky laws, which aimed to prevent speculative ventures that were literally selling nothing but a piece of the blue sky. However, these state-level efforts were inconsistent and ultimately insufficient to control the nationwide tide of unchecked speculation and outright fraud. Practices like pools, where groups of wealthy investors artificially inflated stock prices before dumping them, and wash sales, where individuals bought and sold to themselves to create fake trading volume, were common. Companies often issued stock with minimal disclosure, making it nearly impossible for average investors to truly understand what they were buying. When the market crashed in October 1929, these systemic weaknesses were laid bare. Millions of Americans lost their savings, not just due to the economic downturn, but because the very foundation of trust in the financial system had crumbled. To address this profound crisis and restore public confidence, President Franklin Delano Roosevelt's administration enacted groundbreaking legislation. The first major step was the Securities Act of 1933, which mandated that companies offering securities for sale to the public must disclose financial and other significant information. This act introduced the principle of truth in securities. The following year, the Securities Exchange Act of 1934 was passed. This pivotal law created the Securities and Exchange Commission itself. It empowered the SEC to regulate stock exchanges, brokers, and dealers. Crucially, it also made it illegal for companies to engage in many of the manipulative practices that had been so prevalent, such as insider trading and price manipulation. The SEC was given the authority to enforce these new rules, ensuring greater transparency and fairness. These foundational acts essentially shifted the burden from the buyer to the seller, requiring companies to provide adequate information for investors to make informed decisions, rather than expecting investors to uncover fraud on their own. This marked a monumental shift from the concept of caveat emptor, or buyer beware, to one of mandatory disclosure and federal oversight. The SEC's initial mission was not to guarantee investment returns, but rather to ensure a level playing field and prevent market manipulation. Its very first chairman was Joseph Kennedy, whose immediate task was to regain public trust in capital markets that had been severely damaged. The 1929 market collapse was a painful but ultimately transformative moment in financial history. It served as the undeniable catalyst for robust federal regulation, culminating in the creation of the SEC. This body was designed to protect investors, maintain fair and efficient markets, and facilitate capital formation, fundamentally reshaping the landscape of American finance from one of unregulated risk to one built on transparency and integrity.